I'm Matt Bishar with NAREIT.com here in New York City for REITWeek 2015. I'm joined today by Bob Cutlip, President of Gladstone Commercial Corporation. Bob, thanks so much for joining us.
It's great to be here with you.
Now, the first quarter of 2015 marked the company's 14th consecutive quarter of closing at least one new acquisition. How have you managed to maintain that sort of long-term momentum?
Oh, it's team-based and it's process-based. We really rely on our three leaders, a guy who runs our East region, a guy who runs our South region, and a guy who runs our West region. Each of these gentlemen have tremendous networks. They've nurtured them through the years. They spent a lot of time with these investment sales brokers, telling them what we can do, telling them what we cannot do, telling them where we want to be and where we don't want to be. The end game is we don't waste their time, they don't waste our time. And so we're seeing deals that make sense. Now, the second part of that is the process. We try to make sure that each of our leaders has something in initial review, letter of intent, contract due diligence, and of course closing, so that we're constantly closing deals. And they're supported by an underwriting team that really takes a look at not only the property, not only the location, but the tenant credit. We try to look at all three of those because net lease operator, you're in it for the long haul, you want stable cash flow. And it's been working out pretty well for us.
Now, your team is really looking at secondary growth markets right now. What's the attraction there?
Well, you know, we have always been known as a credit-first buyer, which means, you know, as a net lease operator, you're in it 7, 10, 15 years, so you need to make sure that the credit is good. But location's important. Tenants don't necessarily stay forever, right? And so we're looking at secondary growth markets, and the reason being, with our size, we look at non-investment grade tenants, middle market tenants. They like secondary markets. Since we can underwrite the tenant credit, then we feel comfortable that if we can get 3, 5, 7 assets in a city, at some point you do sell. And if you're going to sell, instead of selling a one-off asset, we sell 3, 4, 5. We get institutions interested, and in the end, we get a lower cap rate, better margins for our shareholders.
And within your diversified portfolio, what assets are showing the greatest strength right now?
You know, historically, we've been in business since 2003. Had to go through the recession. So we've got assets that we still own that we bought 2004, 2006. Industrial's been the best. Some of it's manufacturing, and some of this is related to depreciation. Okay, the basis is lower. But our industrial have been a little over 10%, which is good. Last 2 years, it's probably office because industrial has been really priced up. Cap rates are very low. But I think most important, not so much the high return, is really focusing on stability of the cash flow. And by that I mean, you know, we lose occupancy, we lose return. And as an example, you know, the way we underwrite from a credit standpoint and a property standpoint, we've been focusing a little bit on what we call anchored multi-tenant buildings. By that we mean 2 to 5 tenants, lead tenants in the majority of the building, and the flexibility we want is, even from a risk mitigant standpoint, if at the end of the lease term they need to expand, if it's a single tenant building, they'll leave. But if not, then we can expand it.
Bob, thank you so much for joining us.
Thank you for having me, I appreciate it.
For more on this and other REIT news and analysis, be sure to visit REIT.com.